For decades, the dream of owning a home in the United Kingdom kept moving further out of reach. Prices rose more than 2,300% over the last 50 years, while wages rose only 1,400%. In other words, with every generation, buying a home required proportionally more effort than it did for the one before. And then, in 2026, prices started falling for the third consecutive month. What had seemed impossible for decades was finally happening. But the people who had been locked out of the market for years aren't celebrating. Because falling prices in the middle of economic uncertainty and still elevated interest rates isn't the same thing as affordable housing. And the structural problem that broke the British property market didn't disappear when prices started falling. So why is the first price drop in decades not helping anyone, not those trying to buy, and not those who already own? The British have been taught that owning their own home is part of their DNA. But just over a century ago, the reality was the opposite. The United Kingdom was a nation of renters, and home ownership was a privilege almost completely out of reach. What we're living through now isn't a new crisis. It's the return of a ghost the country spent 100 years trying to bury. In 1913, owning a home in the United Kingdom was a privilege for the few. The vast majority of British families rented, handing over roughly a third of their wages to the landlord every month, accumulating nothing. It was the normal life of almost everyone. 89% of British adults were tenants. Only 10% owned a home of their own. The 20th century changed that. Generation after generation, more British people came to hold the keys to a home that was theirs, not the landlord's. By 2003, 71% of adults were homeowners, the peak of a dream the entire country had embraced. But since then, the trend has reversed. The homeownership rate fell to around 65% in the 2020s, and projections suggest it could keep falling if current trends persist. The dream of homeownership didn't die by accident. It was crushed by a maths that stopped making sense for working people. On one side, prices that ignore the reality of wages. On the other, a shortage of homes the country simply cannot solve. Historically, homes cost between 3 and 4 times the average annual income. That was something you could plan for, something you could actually reach. Today, that number has climbed to nearly 6 times the average salary. That number deserves a pause. It's not just expensive, it's a rupture with everything that came before. An entire generation has been priced out of the market not through lack of effort, but through maths that simply no longer adds up. And the regional differences reveal the true size of the gap. In Northern Ireland, a home costs just over 4 times the average annual salary. But in England, that multiple reaches nearly 8. In other words, to buy an average home in England, a worker would need to save their entire salary spending nothing for nearly 8 years. It's not just expensive, it's mathematically impossible for anyone starting from zero. And saving for the deposit, which needs to be proportionally larger the higher the price, can take an entire decade, while rent consumes most of what would otherwise be savings. But the price issue is only half the problem. The other half is a supply crisis that has been building for decades, and that explains how prices reached this level in the first place. The United Kingdom simply doesn't build enough homes. This isn't a controversial claim, it's a consensus among economists, developers, and the government itself. Behind every waiting list, families waiting years for social housing, young people sharing rooms because they can't afford to rent alone, there is a number. The government estimates the country needs 300,000 new homes per year just to keep pace with demand. But the reality is that it isn't anywhere close. In the last measured period, just over 230,000 homes were delivered. That leaves a gap of 70,000 households that simply don't exist. Year after year, for decades. It's not just a deficit, it's a chronic shortage that pushes prices and rents upward while waiting lists grow. For a low-income family in 2000, there was a waiting list for social housing, but there was a list. The stock existed. 20% of England's homes were social. By 2023, that stock had fallen to 16%. The queue got longer as the places disappeared. The law that accelerated this was the Housing Act of 1980, which expanded the sale of public housing to tenants, the so-called right to buy. Many British people became homeowners through this route. But the homes sold were not replaced at the same rate they were sold. permanently shrinking the affordable stock. The result of decades of this imbalance is plain: prices that rose at more than twice the speed of wages, and an entire generation that grew up accepting that homeownership might no longer be a reasonable expectation. What seemed like the light at the end of the tunnel for an entire generation turned out to be a trap. Prices are finally falling, but you're about to understand why that might be the worst possible news for anyone who still doesn't own a home. Falling prices sound like good news for would-be buyers, but the British property market of 2026 is falling for the wrong reasons. Geopolitical uncertainty, including the Middle East conflict that the Office for Budget Responsibility itself flagged as a significant risk to the British economy, is weighing on consumer confidence. When people are uncertain about the future, they delay big decisions, and buying a home is the largest financial decision most people ever make. At the same time, credit is still expensive. A mortgage that once fit into a middle-income family's budget now consumes a much larger slice of their wages. The Bank of England is holding the base rate at 3.75%, and markets don't expect any meaningful cut before the end of 2026. With that cost, even a fall in property prices doesn't necessarily make buying more affordable. And then there's the broader economy: cautious businesses, hiring put on hold, workers holding off on big decisions. The OBR projects GDP growth of just 1.1% in 2026, the lowest in years outside the pandemic. And unemployment is rising. Every percentage point higher means more families without the stability needed to take on a mortgage. Prices falling in a climate of economic stagnation, rising unemployment, and expensive credit isn't a market that became affordable. It's a market that became frightened. And for the millions of British people who already own homes, many of whom have their property as their primary asset, falling prices aren't neutral news. They're a direct threat to the wealth they spent decades building. But there's a dimension of this problem that almost never makes the headlines, and it's the most revealing of all. There is one figure that sums everything up, and that should be on every headline about the British property market. In 1913, a typical family handed over 32% of their wages just to have somewhere to live. Today, a century later, the number is almost identical. 100 years of economic progress. The same percentage. It's the most devastating diagnosis of the British property market, and it's almost always ignored in the debate about prices. In London, the situation has a name: impossible. There are tenants handing over half their salary every month just to have somewhere to sleep. Average rents have reached more than 50% of typical earnings. And here is the vicious cycle that traps millions of British people. The cost of rent consumes so much of their income that saving for a deposit becomes nearly impossible. Even if prices fall somewhat, the renter who can't save the deposit stays locked out. Falling prices help those who already have capital, not those trying to enter from zero. But while the debate revolves around who's buying and who's selling, there's an invisible cost draining the country's wealth before it even reaches people's pockets. And the size of that hole is far larger than any of us imagined. The Office for Budget Responsibility, the independent body that audits Britain's public finances, roughly equivalent to a national fiscal watchdog, painted a picture in March 2026 of an economy growing slowly, with public debt nearly tripled compared to 20 years ago. One detail stands out: the United Kingdom now pays £106 billion per year just in debt interest. To put that in perspective, that figure is nearly 3 times what the country was paying just 7 years ago. It's money that simply vanishes from the public budget without building a single home, training a single doctor, or fixing a single road. It's the invisible cost of accumulated debt that squeezes everything else. Inflation is falling on paper, but real wages remain stagnant. In practice, the British worker is running on a treadmill going nowhere, earning a little more, but the cost of living and high interest rates take it all before there's any chance of thinking about a deposit. And the OBR has a long-term warning that goes beyond the housing market. If current policies don't change, future generations will inherit a state with little room to invest in anything, including social housing. Public debt could reach 275% of GDP by the 2070s. That matters for housing because it leaves little fiscal room for the government to invest meaningfully in social housing or subsidize first-time buyers. So, what remains? Let's go back to the question we started with this time with all the numbers on the table. So why is the first price drop in decades not helping anyone, not those trying to buy, and not those who already own? Prices falling for the third consecutive month in 2026 is not the resolution of the housing crisis. It's another chapter of it. Prices are falling because the economy is weakening, not because the structural problem has been solved. The construction deficit continues, the cost of credit is still high, the rental market still consumes a third, and in London more than half of the income of those who depend on it. The price drop may open a window, but it only works for those who already have capital for a deposit, job security to get a mortgage, and the nerve to buy in an uncertain market. Those who don't have all three at once stay locked out, and those who already own a home watch the primary asset of their lives lose value at a moment when the economy offers no alternatives. The British property market isn't just a market, it's the most visible thermometer of how an economy is working for ordinary people. When it seizes up, whether because prices rose too far or because they fall for the wrong reasons, the effect reaches into labor mobility, family formation, and the financial stability of entire generations. What that thermometer is showing right now isn't reassuring, and the numbers coming out in the months ahead will tell us whether the United Kingdom is entering a necessary adjustment or the beginning of something more serious. If you want to keep following how these shifts affect the finances of those living and working in the UK, subscribe to the channel. And tell me in the comments, do you think the price drop will create a real opportunity for first-time buyers, or will it reverse before long with another surge?